Markets have been in for quite a ride this year so far after the ups and downs that caught almost everyone by surprise in the first 6 months of this year. Well, what is the best strategy for riding out the rest of the year? Joining me in studio to discuss how to navigate these markets, I'm joined by independent trader and stockbroker and market commentator Petri Redelinghuys, and we've got head of research for Momentum for SP Reid Securities, Stephen Meintjes. Gentlemen, thank you so much for joining us this afternoon. Let me start with you, Stephen. The big thing has really been around Brexit. Markets seem to be on the up and up now. So what was all the big fuss about? Is it over?
No, I don't think it's over, and I think it was at a high level was the nation state against some kind of imperfect economic and financial or monetary union. But I think the real issue was inequality. Obviously immigration came into that. And I think the message that's been taken by financial markets globally is, you know, we the people are unhappy with what has been happening. There's been no growth that's trickled down to us. You better do something, politicians. And I think that's why the markets are anticipating financial, more monetary accommodation.
To what extent do you think Janet Yellen has attributed maybe pausing on interest rates rising? Do you think we're likely to see them make the move, or are we looking at next year sometime?
Okay, so a bit of conspiracy theory perhaps. I think that we have an administration in the United States that has served 2 terms, has done fantastically well. I set a number of records. Unemployment is, you know, record lows. You've got markets at record highs. They've done a fantastic job. Janet Yellen has helped play her part in that role, and I don't think that we're going to see anything that's going to upset the apple cart until after the Obama administration is out. So that's sort of what I think. I think we're going to see very accommodative monetary policy until such time that the elections are over.
Accommodative, would you concur with that? And I think just in taking this discussion forward, we obviously look for economic data points that will give us a signal of where or what the different central banks are likely to do. What data points should we be looking out for, Stephen?
Well, it's not a data point, but I mean, obviously we've got our own municipal elections in a few weeks, and we've got the presidential election. And then we want to see what third quarter GDPs are going to do in the Eurozone, the US and China. Everyone's saying China is going to cool down a little bit, but let's hope it's not too much.
In terms of strategies, and I remember speaking to you, Petri, this was ahead of the Brexit vote that took place. You were looking at specific stocks and exposures that maybe one should have or shouldn't. Hindsight, they always say, is the best kind of side.
Yeah. Look,
which stocks do you wish you had been in? And unfortunately,
well, I suppose I wish I'd been short capital and counties, you know. But I think, you know, I got the Brexit thing wrong. I didn't think that they were going to exit, and they did. So I was sort of very risk averse, and the stocks that I was in back then, I'm still in mostly now. On the longer term equity side, that's essentially Sasol and Anglos and Sintova and Transaction Capital, Aspen, those types of very, I consider them to be defensive. I think that the resources space is very aggressive at this point, but I think that that's almost where the smart money is going. You know, I reserve the right to be wrong, as I was wrong on Brexit and many other things in the past. But yeah, I think even if you could look back, the reaction we saw in the market wasn't quite what was expected. We'd been told that the world is going to collapse when Brexit takes place, and for 2 days that seemed like the truth. However, I don't know, perhaps rationality, perhaps people started to realize that the fallout of Brexit isn't going to, you know, Europe isn't going to crack in a day. It's going to take a couple of years for Brexit to really actually take place. There's a lot of negotiating that needs to be done, so the real economic impact is only going to be felt a lot longer. And obviously now, with the uncertainty, this breeds hope for further stimulus in the form of interest rate cuts out of the US and interest rate cuts out of the UK. So this has pushed markets higher. So I think that it's, you know, it's caught me a little bit by surprise, to be honest. Going forward, I think that, you know, for the rest of the year, I do still think that resources is probably the best place to get return for the rest of the year. Whether or not that's right, only time will tell.
Stephen, do you agree in terms of where one should be putting their money? And were you right? I mean, what did
No,
you...
no. We also own up to Capco, and getting Brexit wrong.
So would now be the time to go in?
Well, I think, yes, a month ago cash was a great place to be, and I think one can just go generally a spread of equities globally. I think Japan, the surge in the yen is probably over, so I think Japanese equities are okay. The US is not, you're not going to get great returns, but I think they will be positive. I think it's still a kind of safe haven. Let's see what happens to the Eurozone economy. As far as our own equities are concerned, I think we've had a jolly good recovery in resources. I'm a little bit, that's why I mentioned the Chinese GDP. If that cools off, then I think, we can see some of those commodity prices easing back a bit. And with that, the resources. So I'd be looking to buy them a bit later on. Retailers, I think we should steer clear of. Funny enough, I think, yes, I'm not saying oil prices are going to go up this year, far from it, but I think there's beginning to be value in the energy stocks. I tend to go for Total rather than Sasol at this point. Sasol's capex has still got to unwind. We've still got to see how successful that's going to be. And of the 8 global majors, Total is by far the cheapest on a sort of EV/EBITDA of 5.9 or so. So that would be one to look at.
You mentioned Total as one. If you had to have certain assets that you must have in your portfolio right now to guard against the rest of 2016, this is fairly short term. So
well, I think in terms of a local equity, Aspen's going to continue doing well. It's it's recovering quite nicely at the moment, and I think our financials are showing pretty good value, and I think they also have been unduly, how should we say, down-rated by Brexit in the first instance and the potential South African sovereign downgrade in the second. So yeah, I'd go for one of the banks, Standard Bank.
Not afraid of the contagion effect regarding banks?
Well, I don't know. I'm a little more bearish on financials, but not for any sort of mathematical, quantitative type reason. I just think that we've seen a very interesting correlation between particular, the financial sector and the resources sector, and I think that financials and industrials on one side versus resources on the other side, they've essentially been moving in opposite directions for the last couple of years. And if that, if we start seeing a bottom in the resources and energy space, or resources in particular, then if that correlation stays in place, then we should see the other two sectors coming down. So that's almost the only reason why I would steer clear of them at this stage. And just sort of general industrials, I agree on the retailers. The rand's firmed up quite significantly, which has provided them with a lot of support. But if we do not manage to hang on to the gains in the rand, then I think we'll feel the pain.
Stephen, you mentioned Aspen as being one of the the companies that you think we should certainly buy into. The emerging market story and Venezuela comes to mind, and their exposure there. I'm not sure how you're reading that particular economic dynamics that are unfolding there. To what extent do you think this may pose a bit of a headache for Aspen?
Well, they're certainly venturing all around the world. I don't know that Venezuela is huge in their universe, and the thing is they are expanding elsewhere as well. So I think basically that that's going to stand them in good stead.
Away from equities, and before I come back to Petri, looking at our bond market, and of course we've seen investors at the moment searching for yield. The bond market, SA, certainly looking attractive versus what we've been seeing in other parts of the world.
Give me 8.6 rather than 10-year US Treasury at 1.36. Obviously there's all the risk, but I think there are, I'm not saying I think that, but I think there are enough global investors thinking that to warrant a bit of support for our local gilts. The search for yield is going to last a long time.
Search for yield going to last a long time. Let's going from the bond market to the currency market then, Petri.
Which means a stronger rand, right?
Yeah, right. So how do you play this?
Well, currently I'm positioned long the rand, short dollar. But it's a very, very, very small position because I'm not that convicted at this point. But if it starts working in your favor, then or working in my favor, then I'll add to it a little bit. However, yeah, I don't really know. I think that the search field continues. I think by the end of the year we start panicking again about this possible sovereign downgrade. Are we going to cut it? Are we not? Because we know, sometimes the market gets very excited about stuff. So I think for now, I'm just kind of playing it carefully. I've got my longer term thing is in place, and for the rest of it, just really sort of trying to react to what the market is doing. I think in general, it's been very expensive for me to take views on what I believe is going to happen. For example, I'd been very bearish the market for over the last 12 months, maybe more, because I see this giant consolidating pattern. The market's not making any gains in the last 2 years, and come January, we're trading close to the low of the range. So I'm thinking this place is going to crash, this place is going to crash, and then goes straight back to the top of the range. Now we've broken out the top. So that view of being super bearish at that point was, well, at the time I think it was probably right because it looked negative, but the fact is that the support level had held. The consolidation continues, and the market moved back higher. So I think that taking a view on what I believe is going to happen for the remainder of the year or the next 2 years is not something that I'm willing to do. I'm rather more willing to stay flexible and react to what the market does. If the market pulls up, it's made a new high. If it closes here for the week, that's a long trigger, then you have to follow the market.
Unfortunately, gentlemen, we do have to wrap, but I must just ask very briefly, I know your view on resources. So gold coins, go in now, yes, no?
No, I would never buy gold coins. No.
Stephen? 3 grand,
yes? Gold is going to bubble around, and if we're going to have low interest rates for a long time, then a couple of $2,000 won't do any harm.
Well, we did try and get you analysis on how to manage your finances. A very big thank you to independent trader Petri Redelinghuys and head of research at Momentum SP Reid Securities, Stephen Meintjes.